Let's start with a simple idea. Imagine your town's economy is a big bucket filled with capital. Every dollar that's earned and spent right there in the community, it keeps that bucket full. But, for decades now, small towns all over the country have watched their buckets spring leaks, just draining away capital, jobs, and opportunity. So today, we're going to figure out how those leaks started, why the so-called fixes just made everything worse, and what it might actually take to start patching the holes.
It wasn't that long ago, in places like Sioux Rapids, Iowa, that the bucket was pretty much full. It was a closed loop. Local life was built on this one powerful idea. Everyone mattered. The money, it just stayed home. This quote really captures that world, a time when the economic health of your community and the social bonds between people were basically the same thing. So how did a system like that actually work?
Well, it worked because of what's called a high-velocity loop. Think about it like this. A farmer pays the local equipment dealer. That dealer turns around and buys groceries from the local store. The grocer then deposits that exact same dollar in the local bank. And what does the bank do? It loans it right back out to a young couple trying to buy their first home. That $1 did the work of $5, maybe $10, all because it never left town. That was the engine that kept the bucket full.
So, what went wrong? Well, the first big leak wasn't some huge disaster. It was a slow, quiet drain that started with a single federal policy, a rule that looked small on the surface but ended up drilling the very first hole in that community bucket.
And that rule was called Regulation Q. Yeah, I know it sounds incredibly boring, some piece of financial plumbing, but its effect was massive. For decades, it put a hard legal ceiling on the interest rates that your little hometown bank could pay you on your savings account. And for a while, that really didn't matter all that much. But then, things started to change. And you can see the problem crystal clear right here. By the 1960s and 70s, interest rates out in the national market started to climb. You could get 5% on a safe treasury bill, but because of Regulation Q, your local bank in Sioux Rapids was legally forbidden from paying you more than, say, 3%. All of a sudden, keeping your money local meant you were actively losing money.
And this is exactly what happened next. Economists have a super fancy word for it, disintermediation. But really, all it means is that capital was fleeing town. Savers, doing the logical thing, pulled their money out to chase those higher rates in new national money market funds. And that siphoned deposits right out of the local banks, which meant they had less money to lend out for a new tractor or a business expansion or a mortgage. That high-velocity loop was starting to break down. The bucket was leaking. So by the 1980s, pretty much everyone agreed Regulation Q was a huge problem. And the solutions seemed obvious, right? Just get rid of the caps, let local banks compete. But what happened next? This is the crucial, kind of crazy twist in the whole story. The attempt to patch that one little hole ended up blasting the entire bottom out of the bucket. So you'd think, okay, repeal the caps, level the playing field, and local banks can finally bring all that money back home. Problem solved, right? Nope, not even close. It unleashed a flood. Instead of helping community banks win back their local savings, getting rid of the caps forced them into a price war. A war they could never, ever win against giant national players with huge economies of scale and multi-million-dollar marketing budgets.
And as you can see here, repealing Regulation Q was just the first domino. It set off a whole cascade of deregulation. In 1999, you get the Graham-Leach-Bliley Act, which basically tore down all the walls between regular banking, investment banking, and insurance, creating these massive financial supermarkets. Then, just 1 year later, the Commodity Futures Modernization Act put securitization on steroids. That meant a mortgage made in a tiny town could be chopped up, bundled with thousands of others, and sold to an investor anywhere on the planet. The total effect of all this was a complete revolution in finance. Capital was no longer tied to a place or to a person. It was officially footloose, free to chase the highest return anywhere in the world instantly. And the profits, the fees, the actual decision-making power, it all moved to Wall Street. The local bucket was just about empty.
Okay, so if the old system is gone and the so-called fixes just made everything worse, where do we even start? How do we begin to patch that bucket? Well, the answer isn't about trying to turn back the clock. It's about recognizing and really restoring a type of value that our entire modern financial system has been designed to ignore.
And that value has a name: civic collateral. This isn't about how much land you own or what equipment you have. It's the value of your reputation, your family's history in that town, your standing in the community.
It's the kind of collateral a local banker understood in their bones because they knew you. They coached your kid's little league team. They saw you in the pews at church.
This slide really just lays it all out, doesn't it? The old system of relationship banking was built on civic knowledge. The goal was to help the whole community do well. The new system of algorithmic lending? It's built on data points and credit scores, and its only goal is to maximize short-term profit. The decision maker isn't your neighbor anymore. It's some distant black box algorithm that has no way to price your civic collateral, so it just pretends it doesn't exist.
And that brings us right to today, because this isn't just an interesting history lesson. This is a direct, urgent message, a mandate, really, for today's financial regulators. It is time to act. Let's be very clear. For decades, the rules of the game have been written, whether on purpose or not, to systematically ignore the single most important asset our communities have. The system has been designed to prioritize footloose, extractive capital over the kind of patient capital that actually builds strong, resilient towns.
So the first demand is incredibly simple. Stop ignoring civic collateral. Recognize that a person's character, their integrity, their commitment to their community, that this has real, tangible economic value. And then write rules that actually allow lenders to recognize it too.
And this isn't about nostalgia. This is just straight-up economics. Civic collateral is the bedrock of local economies. It's what allows a young farmer to get their start or a small business to survive a tough year. A system that makes this bedrock worthless is a system that is designed to fail those communities.
The entire regulatory framework has to be reset. It needs to be flipped on its head. It has to start rewarding patient capital, the kind that stays and builds for the long haul, not the extractive capital that just drains value for a quick quarterly profit. The system needs to incentivize the thriving of a community, not just a short-term yield.
And finally, rebuild the missing middle. Decades of deregulation didn't just empower Wall Street. They hollowed out the whole ecosystem of community banks, local credit unions, and regional co-ops that used to be the bedrock of local finance. We need policies that actively support and rebuild these institutions that keep capital rooted in a place.
So that leaves us with one last crucial question. The leaks in that bucket, they weren't an accident. They were the result of very specific choices, of policies we designed. So the question for us is, will we keep designing systems that systematically drain our communities dry, or will we finally decide to pick up the tools and start patching the leaks?